What is current ratio? How we can interpret that? What does it mean? What is the beta current ratio? And some examples. Would you like to know more about this? Stay with us till end of the video. This is Milad Akbari and welcome to Akbari Education. As I said, we're gonna discuss the current ratio. First of all, what is liquidity ratio? This is something we're gonna cover. The current ratio, interpretation about that, explanation complete, the limitations it have, and example and practice question. That's what we're gonna cover in this video. First, liquidity ratios. Liquidity ratios are an important class of financial metrics used to determine a debtor's ability to pay off current debt obligations without raising external capital. Overall, liquidity ratio is as a parent of some ratios under that, which we're gonna cover in future videos. Here we're gonna cover the current ratio. It explains the company's ability to cover its short-term obligations, short-term debts with its short-term assets available. It prevents the company to raise or need to raise foreign or external capital. Suppose I'm in a balance of liability, a short-term liability of $5,000, and I need to pay that $5,000. Am I able to cover that $5,000 with the asset available inside the business, with the short-term asset available inside the business, or I need to raise some foreign capital from other party? I need to receive a loan. That is something which shows the liquidity ratio of the business. For the first one, the current ratio, or we call it the working capital ratio. The current ratio is a liquidity ratio. It's part of the liquidity ratios that measures the company's ability to pay short-term obligations or those due within 1 year. What does it mean? With the current ratio, we're gonna measure whether the company is able to cover its short-term obligation. What is the short-term obligation? Mostly the current liabilities, which are payable within 1 year. Is the company able to cover these short-term liabilities with its short-term assets or current assets or no? This is the current ratio. It tells investors and analysts how a company current assets on its balance sheet is able to satisfy its current debts and other short-term payables. Mostly the investors and analysts come, even the students come to analyze the financial statement for the research purpose, for the thesis purpose. But from the perspective of investor or analyst, it shows the company's current assets are able to cover the short-term payables, the current liabilities or no. That's it. A current ratio that is in line with industry average or slightly higher is generally considered acceptable. What ratio is acceptable? A ratio which is equal to average of the industry, to the similar companies, to similar industry. Equal to that or slightly a bit higher than the average of the industry is called acceptable. That's something acceptable. A current ratio that is lower than the industry average may indicate a high risk of distress or default. If it is lower than the average of the industry, it may indicate that the company is a bit incapable of covering their short-term liability in comparison to the industry, in comparison to the peer group. Similarly, if a company has a very high current ratio, a very high, more than the industry average, compared with its peer group or industry average, it indicates that management may not be using its assets efficiently. That's one of the important points, okay? Suppose a company have industry averages around about 1, the current ratio industry average is 1, but the company have a current ratio of 5. This indicates that the company was unable to efficiently utilize its asset, like investing it. The management was unable to do that. Let me go by an example. Suppose the company have $50,000 short-term liabilities overall, and they have $500,000 of current asset. It means that it is 10 times higher than what the current liability they need to pay. And if they suppose pay from that $500,000, the $50,000 of this current liability, they remain with $450,000. And it indicates that the management was unable to efficiently utilize or invest this amount of cash in other purpose to generate further revenue for the business. This is something you need to remember. Let's go ahead. Interpretation of what does it mean? In many cases, a company with a current ratio of less than 1 does not have the capital on hand to meet its short-term obligations if they were all due at once. Let's go to the next slide. It's about the formula. Let's learn that. I will come back and explain what is mentioned in previous slide. The formula for current ratio is the current ratio, pick up the pen. The current ratio is equal to the current asset of the business divided by the current liability of the business. What is current asset? Those assets which can turn into cash within 1 year. And what's current liability? Those obligations which are payable within 1 year. In simple word, we have another video inside the channel. It's about the balance sheet, statement of financial position, statement of performance, and the elements of financial statement. You're gonna go there. It has been explained with examples in detail. So let's go ahead. To calculate the ratio, analysts compare a company's current asset by the current liability. By dividing the current asset to the current liability, we're gonna have the current ratio here. Current assets listed on a company's balance sheet include, this is some of the example of that. It can be cash, it can be account receivable, it can be inventory, it can be other current assets such as marketable securities, such as other short-term investments, and many other which the business decided to be considered as a short-term current asset, as a current asset overall, or they have the nature of a liquidity less than 1 year. It's called current asset. We can add them together and put them in place of current asset. Current liabilities include accounts payable, wages, salaries payable, taxes payable, short-term debts, and even the current portion of long-term debt. Suppose a company have a debt of 30 years and they need to pay in next year a portion of that long-term loan. That portion can be considered as a short-term portion of long-term debt or a current portion of long-term debt. That's as per the standards. We're gonna cover that in future videos, but that's a normal case. So we will add them together and we will consider that as a current liability. So if we divide the current asset to the current liability, if the ratio come to less than 1, it's not acceptable. Why? It means that the company is not able in short term to cover the short term obligations, is not able with its current asset to cover its current liability. That's why the ratio which comes to the current asset divided by current liability, it is lower than 1. But if it's greater than 1, it indicates that company will remain solvent. They have the ability to pay the short-term liability with the available short-term or current asset. However, one thing should be clear. Suppose you are going to compare the Microsoft with the Boeing, or you are comparing Apple company with another real estate company. So the nature may different. Real estate have a nature of inventory which is a bit longer in period. Most of the time it reached to near to 1 year, and even some of the time it crossed the 1 year, but it's inventory. Some of the company have account receivable of long term, but its nature is a bit long term. But some of the companies have account receivable which is within 10 or 15 days or 1 month. And the nature of the business overall affects the interpretation you're gonna do on current assets. So consider that one. You cannot compare the industries, which are very much different. You need to go with the comparisons and analyzing the companies which are from the same nature, same industry. That will be the great point. The formula I have explained. Let's go ahead with the limitations of using the current ratio. As I said, comparing various companies or industries is a bit difficult. Suppose I'm an analyst and I would like to compare the Boeing with the Microsoft. It's tough to use the current ratio only for such cases. The current ratio of them may be different, but they may have a very abnormal current ratio comparing each other, but in their own industry, they have a similar and very nice, the acceptable current ratio. Incorporate all current assets which may not liquidated easily, such as inventory. One of the cases here, as I said, the real estate company may have the inventory which is a bit long term in duration of liquidation. It may cross the 6 months, but suppose the supermarket have an inventory which goes daily, it changes daily, so comparing them is a bit tough. An inclusion of inventory, current assets such as account receivable, prepaid expenses may make the comparisons for the analyst and investor a bit tough. So you need to consider that one. There are some other liquidity ratios such as asset test ratio, which solve this point. We will have the video related to that. You can see that as well. Not enough as the only source for analyzing and decision making. Suppose I'm trying to decide whether I would like to invest in a company or not. Only going with considering the current ratio of the company is not enough. We need to consider many other areas, many other ratios, the foundation of that company, and many other aspects, the name, reputation of that company. After that, we can go with deciding whether the company is good for the investment or not. So you need to consider that one. Let's go to an example. Example said a company holds a cash of suppose about 15 million, marketable security, which is a short-term asset, a current asset of 20 million, inventory of 25 million, which is also a current asset. This is all put together is the current asset of the company. And on the other side, they have a short-term debt of suppose 15 million, accounts payable of 15 million, which made the current liability of the company. Now they ask us to calculate the current ratio. Simply, we gonna add the cash plus the marketable securities plus the inventory to give us the 16 million of the current assets, and divide that by the current liability, which is 15 million of the short-term debts and 15 million of accounts payable, which gave us the 13 million current liability. When we divide this together, it will give us the 2 ratio of 2. What does it mean? I have 2 times more current asset than in comparison, or then what I need to pay in short term. Suppose even with the words of this example, I need to pay $30,000 as a short-term liability, but I have $60,000. That's why we have 2 times more than what we need to pay in short term. That's the example. As always, let's go to practice question. The practice question is a bit tricky and scenario based somehow. Let's read it. A company has the following details extracted from its statement of financial position. They have the inventory, which is current asset, the receivable, which is current asset, bank overdraft, which is current liability, and payable, which is current liability. Inventory and receivable, you know that bank overdraft is somehow an agreement between the business and the banker, the bank, which they allow to overdraw, means to overdraw over what they have available inside your current account. Suppose they have $5,000 inside the account, but they agreed to even withdraw more than $5,000 as a liability from the bank side. That's called overdraft. And payable is payable, of course, something you have purchased and you need to pay that back. The the company operates in has a current ratio norm of 1.8. That's the average, that's the industry average, that's the norm of 1.8, the current ratio. Companies who manage liquidity well in this industry have a current ratio lower than the norm. If a company wants to be considered to well manage their current ratio, the current asset and current liability, they should have lower than 1.8. If they have a current ratio of lower than 1.8, they are considered to be somehow good, in a better position, in a better control. Let's continue. Which of the following statements accurately describes the company's liquidity position? We have the four options. Liquidity appears to be well managed as the bank overdraft is relatively low. Liquidity appears to be poorly controlled as shown by the large payables balance. C. Liquidity appears to be poorly controlled as shown by the company's relatively high current ratio. D. Liquidity appears to be poorly controlled as shown by the existence of a bank overdraft. I recommend you pause the video, work on that, calculate, think of that, choose your option. I will go ahead. Okay, let's go ahead. Four options available. Let's first of all calculate what is our current ratio. Our current ratio for the current asset, we have the 1,900, which is 1.9 million, plus the 1,000 divided by what we have in current liability, 100 plus 1 million. It is equal to, in numerator we have 2,900, in denominator we have 1,100, which is 2.9 million and 1.1 million. If we divide them together, let me have my calculator here. For the calculator, 2,900 divided by 1,100, it reached to 2.64. 2.64, and that is higher than 1.8 as a norm of the industry. So what we can consider now, the company is in a bad position in comparing to the norm of the industry. That's something we have understand, but let's go to the options. Option A said liquidity appears to be well managed as the bank overdraft is relatively low. It's not well managed, they are in a poor position. So option A is not correct. Option B, liquidity appears to be poorly controlled. It can be the option. As shown by the large payables balance, the company's balance of payable is not too much. It's 1 million. In comparison to other figures, it seems okay. Option C, liquidity appears to be poorly controlled as shown by the company's relatively high current ratio. So the position of the company, liquidity appears to be bad because they have a higher liquidity. It seems to be the good response now, but let's go to the D and check whether it's also good or no, or it's wrong. Liquidity appears to be poorly controlled as shown by the existence of a bank overdraft, but the overdraft is only $100,000. It does not affect it that much, and it cannot be the only reason of this bad position of the liquidity. So the correct option, which is the better option to be selected here, is option C. And so option C is it indicates that the company is in a bad position in comparison to the norm of the industry. That was the point. I wish you understand, you learned something from here, and I wish I was helpful in teaching you this point. These are the basic points which is required by all the students who want to come and enter to the international accountancy. So I recommend you share this with your friends, with your colleagues, with your classmates. And thank you so much for being with us till the end of the video. Remember to subscribe and like the video.